Let's get straight to it. The financial world is buzzing with activity, and there's a major trend you need to know about. European companies are snapping up their own shares at record-breaking levels, making headlines across the continent and beyond. In November 2025 alone, they spent a staggering $19.3 billion on buybacks, a surge we haven't witnessed in years, and it's turning heads in the investment community. This isn't just a one-off event. Throughout 2025, companies have announced plans to buy back a massive $250 billion worth of shares, roughly 2% of the entire European stock market's value. Think of it as a giant vote of confidence. When companies buy back their own shares, they're signaling strong belief in their future growth and stability. Why should you care? Because buybacks can make your shares more valuable by reducing the number of shares in circulation, often pushing prices higher and benefiting existing shareholders. This surge comes after a period of economic uncertainty, with companies now feeling more secure and ready to take bold action. They're looking ahead to 2026, seeing brighter skies on the horizon, and using buybacks as a strategic tool to prepare for what's next. In this guide, I'll break down exactly what's happening, highlight which companies are leading the charge, and explain why this is all happening right now. We'll explore what this means for profits, dividends, and, most importantly, how it could impact your investments and financial future. It's a big story with real consequences, but I'll cut through the jargon and give you the facts you need. Let's dive in and see what's really going on. Let's demystify share buybacks, a financial strategy that's become increasingly popular among companies worldwide. Imagine a company as a cake sliced into millions of pieces. Each slice is a share. When you own a slice, you own a piece of the company and its future profits. When a company buys back its own shares, it's removing slices from the cake, making each remaining piece bigger and more valuable. Fewer slices mean each shareholder's portion of the company grows, even if they don't buy more shares. The main reason? To boost the value of the remaining shares and increase earnings per share, EPS, a key number investors watch. A higher EPS can make the company look more attractive to potential investors. Buybacks also signal management's confidence that their shares are undervalued. It's like the company saying, "We believe our stock is worth more than the market thinks." It's a way for companies to invest in themselves, often seen as a better use of cash than other options like sitting on reserves or making risky acquisitions. Buybacks can also be more tax efficient for investors than dividends, since shareholders may avoid immediate taxes and potentially benefit from capital gains later. Companies with spare cash can reinvest, pay dividends, or buy back shares. And lately, buybacks have been the top choice, especially in competitive markets. With interest rates making other investments less appealing, European firms see buybacks as the smartest move to reward shareholders and strengthen their stock. Ultimately, it's a powerful message. We believe in our future and are committed to delivering value to our shareholders.
The $19.3 billion spent in November 2025 is one of the highest monthly totals since 2017. Buybacks made up 2.3% of all trading on European stock exchanges that month. Companies weren't just testing the waters, they dove in. This surge followed the end of a blackout period when companies can't buy back shares.
Across 2025, Stoxx 600 companies announced $250 billion in buybacks, about 2% of their total market value. Energy and financial sectors led the charge, with buybacks making up more than 2.5% of their trading volume. These sectors are flush with cash and optimistic about the future. There's still plenty of firepower left. 70% of buyback funds for 2026 haven't been spent yet. Analysts expect $50 billion in new buyback announcements in early 2026. The momentum is set to continue.
Which companies are behind these massive buybacks? The biggest names in Europe. British American Tobacco tops the list with $10.9 billion left to spend, followed by Novartis, $8.6 billion, and Equinor, $7.8 billion.
Other major players include ASML, $5.3 billion, and Anheuser-Busch InBev, $5 billion. Countries like Norway, Portugal, and the UK are leading in total returns to shareholders. Finland, Belgium, and Norway have the largest unexecuted buyback capacity, meaning more buybacks could be coming. A special buyback basket of stocks tracked by Barclays surged 24.3% in the last year, compared to the broader market's 11.9%. Companies actively buying back shares have outperformed the rest of the market. 12.
What's driving this buyback boom? It's a perfect storm of conditions.
First, companies are sitting on record cash reserves, about 11% of their assets, much higher than usual. After years of caution, they're ready to put that cash to work.
Second, interest rates are peaking, and the European Central Bank is expected to cut rates in 2026. Lower rates make holding cash less attractive and signal a more stable economic environment.
Third, economic indicators like PMIs are improving, suggesting business activity is picking up. Companies feel more secure about future earnings and are willing to spend on buybacks.
Finally, buyback stocks have outperformed, creating a self-reinforcing cycle. Success breeds more buybacks. The post-blackout rally in October, where stocks typically rise 2%, encouraged even more buybacks in November.
This demonstrates how local policy decisions can dramatically impact not only corporate strategy, but also shareholder returns and the broader investment landscape. When governments introduce new regulations or taxes, companies are often forced to rethink their financial plans and adapt quickly to changing conditions. Investors need to pay close attention to country-specific rules and regulations, not just the global economic picture. Local nuances can make a significant difference in outcomes, sometimes even outweighing broader market trends. The French case is a vivid, real-time example of how a single law or policy can shift the entire corporate landscape, influencing everything from boardroom decisions to investor confidence. Across Europe, there's a patchwork of approaches. Not all countries are moving in lockstep, and each government's stance can create unique opportunities or challenges for businesses and investors alike. France stands out as a notable exception, charting its own course amid broader European trends. The French government is now proposing a steep tax hike on share buybacks, potentially up to 33%, as part of its 2026 budget. This move is designed to encourage companies to reinvest profits or pay out dividends instead. As a result, many French companies have adopted a wait-and-see approach, slowing their buyback activity and holding off on major decisions until the policy is finalized. The French Senate, which tends to have a more pro-business stance, is currently reviewing the proposal. Lawmakers have until December 15, 2025, to make a final decision, and the outcome remains uncertain. If the tax is softened or rejected, French buybacks could surge in 2026, potentially boosting stock prices and rewarding shareholders. If the tax goes through as planned, companies may shift their focus to dividends or alternative investments, reshaping the way value is returned to shareholders in France.
Buybacks are more than financial moves. They're a signal of management's confidence in the company's future. After years of challenges, leaders are optimistic, seeing strong balance sheets and improving economic indicators. They're shifting from defense to offense, ready to reward shareholders. Energy and financial sectors are leading, reflecting strong earnings and resilience. Banks in particular are in a strong capital position, a big change from the post-2008 crisis years. Free cash flow yield, a measure of how much cash a company generates, is highest in sectors like automotive, telecom, and energy. These sectors are fueling buybacks and dividends, showing robust health. High cash generation is the engine behind shareholder returns.
The buyback boom is setting the stage for European companies to thrive and share that success with shareholders. 1. S4. Media Group. Close-up of financial analyst reviewing earnings report. Investor reading dividend statement. Stock. Distribute equally. Buybacks have a direct impact on the numbers investors care about most: earnings and dividends. As companies buy back shares, earnings per share, EPS, goes up, even if total profits stay the same. Analysts at Barclays forecast an 8% EPS growth for European companies in 2026, much of it driven by buybacks. Strong buybacks often signal strong dividend growth, since both come from excess cash. For 2026, dividend growth for StoxX 600 companies is forecast at 5%. The combination of rising EPS and growing dividends means higher share prices and more income for investors. This total return is what investing is all about.
So, what does all this mean for you? In short, good news. The buyback boom signals that Europe's biggest companies are confident and cash-rich. If you own a tracker fund following a major European index, you're already benefiting from this trend. Buybacks by the largest companies help lift the value of your fund. For stock pickers, look at sectors leading the buyback charge, financials and energy, or companies with big buyback plans like Novartis or ASML. Buybacks are a sign of management confidence, a key ingredient for investment success. This $19 billion surge reflects a shift from caution to confidence, suggesting stability and growth ahead in 2026. Healthy, cash-rich companies are generally good places for your money. Right now, Europe has plenty of them.